Good day to all. This is our discussions involving audit of the capital acquisition and repayment cycle under auditing and assurance services series. So first stop or objective is really to go into the accounts that are affected by the cycle. And this time we will have to look into also the unique characteristics. First is that we have to take note that the capital acquisition and repayment cycle will only involve relatively few transactions because normally these transactions actually are going to be done in only isolated and very few circumstances. But then we have to take note that the amount would be highly material or even material or very material. Example of this one is to be able to acquire or have capitalization needed for the business, our clients would normally look into possible sources from debt financing. So that is issuance of bonds or bonds payable, and then borrowing of money in the form of notes. So in such two cases, normally these are done in very few circumstances or transactions, but then we're talking here about millions and billions of pesos or dollars. Then number two, the exclusion of a single transaction could be material in itself. That's very true. If let's say the company issues bonds payable amounting to 50 million pesos, so the omission of that is really material. And that would have impact also for statement of cash flows, by the way, under financing activities. Okay, next. There is a legal relationship that exists between the client entity and the holder of stock, for example, for the shares of corporations which are issued to investors or shareholders or stockholders. And then the bondholders, if the company would be issuing the bonds, so the company is the issuer, and then whoever holds the bond has an, let's say, unconditional right to receive the cash flows in the form of principal and interest of those particular bonds. So these investors are actually the creditors, and the company now is the debtor or the one that has the liability to pay the bondholders. So in this particular situation, this is in opposition of holder of the stock. So we have to take note that if a certain person, whether natural or legal or artificial, of course, right, under the laws that we have or taxation laws also, that we have two persons, natural and the artificial. So natural human beings, artificial, we have the businesses or corporations, for example. If let's say a certain corporation issues stocks to these persons, then these persons would become equity holders, would become owners of such corporation or issuing corporation. But for a bond transaction, the company that issues the bond actually is the one that has a liability. And then the one that is holding the bond has a right to collect the cash flows related to such. I hope that is clear. Then similar ownership document. So whoever has transaction with our client or clients, normally they have legal relationships then. Number four, a direct relationship exists between the interest, so for the debt, and dividends for the equity accounts or the stocks or shares of corporation. Then these are the accounts. There's a list, although not exhaustive, meaning this is not a complete list of accounts that are affected by the cycle. The cycle again is capital acquisition and repayment. So if, for example, we acquire the said financing or resources of the business in a form of liability, there is clearly an obligation to repay the debtors or lenders of money. So, and of course, debtors will have to pay, by the way, the creditors or lenders. That's what I meant, or we meant. Then notes payable, contracts payable for certain contracts in which the client has or will have obligations to pay. either in cash or other claims for cash or other assets. Then mortgages payable normally are loans in which there are collaterals. Bonds payable explained already. So these are the four payables normally: notes or loans payable. Mortgages would be notes or loans with collaterals. Then for interest expense in relation to debt, so the first four normally are interest bearing. Accrued interest would be the interest unpaid, which have been accumulated in relation to those liabilities or the above liabilities. Then appropriations of retained earnings, you have to take note that retained earnings is now known as accumulated profits and losses. So any earmarking or setting aside of portions of retained earnings will be also part of the cycle, because retained earnings normally is free, which means that it is available for distribution as dividends to shareholders or investors or stockholders. But then if they're appropriated, this would mean that such is now being set aside for certain purposes. For example, for certain long-term projects or business endeavors. So that's capitalization. Treasury stock or treasury share is a stock or share that is reacquired by the corporation. Normally, if there is no other bidder, or let's say no bidder at all for certain stocks that are being obtained again by the corporation. So in that case, the corporation has to buy back those shares. Then dividends declared also will be affected, although these latter two normally are not sources of capital. Next, also assets are to be affected like cash in bank, then items of the equity from common stock, now known as ordinary share because we are using IAS terms in the Philippines, then preferred stock or preference shares. Paid in capital and excessive part, that's share premium. Donated capital is any donation coming from a shareholder. Retained earnings, again, accumulated profits and losses. The dividends, which are currently payable, are dividends payable in the form of cash and other assets. Then for a proprietorship or single or sole proprietorship business, the capital account as well as the partnership for the partner's capital accounts will be affected by the cycle or in the cycle. For designing the tests of balances for notes payable, normally, again, this is the usual setup that we have to understand the business risks in which the objectives of the organization will not be met by the management or the business or the client. Then we set also our tolerable misstatement or performance materiality level, which is the level in which we can accept that such misstatement would be immaterial. So that is tolerable or allowable. Anything that is equal perhaps or above that, clearly what is equal is to be determined, but what is above is automatically materially stated or misstated. Okay, phase one after that is related to control risk. So the system or procedure in the organization will have to be checked. Then also the TOC and the STOT in relation to the cycle will be examined. We also perform the ratios, then test of details of balances, the TDB, in order also to align with our management assertions or representations like existence or occurrence and etc. Since we're talking about normally liabilities here, the tendency is that the notes payable, for example, as an example of the liabilities, would be misstated, geared towards understatement. Normally, they are understated, and that's why we perform normally existence or occurrence assertion, in that we are going to check if ever what has been recorded actually have existed. So that's why the flow is from our accounting records to source documents in order to vouch such entries on the journals, for example, or the ledgers. Then we have to take note also in terms of the risk that the riskier there is, or the riskier a business would be in terms of a certain account like notes payable, So we have to perform more audit procedures, increase the sample size, select more items, and then we actually do the audit close to the end of the reporting period. Next, we design and perform audit tests of notes payable and related accounts and transactions. So we have here, take note that in a notes payable, there are two parties, the debtor and the creditor. The debtor has the legal obligation, which is our company, to pay the creditor the amount, sum, so the principal and the note, including the interest, because normally notes payable are interest-bearing notes or item. Then they may be secured or unsecured by assets, depending on the amount of the transaction or value of money borrowed. Then certain amounts would not be required with collaterals, but others will be required. So it is a matter of policy of the banks. Then what are the objectives in the audit of this account, notes payable? We have to check that internal controls are adequate so that whatever controls there are such would be able to safeguard or protect the company's assets. And also, we will have to make sure that the notes payable have been properly recorded as authorized and record liabilities and expenses at correct amounts. Internal controls would be authorization was done before the issuance of any new notes. Then there should be adequate controls over the repayment. We have to make sure that there's also authorization for such. Proper documentation and keeping of records should be maintained, and independent verification, which is done periodically, should also be maintained. We have to reconcile all records available, the source documents, the journals, and the ledgers, as well as the financial statements should be congruent with each other or aligned. Here are the accounts which are affected by notes payable. So the liability, normal balance would be credit, so that any issuance of the notes would be an addition, but payment would be a debit or a minus. In cash in bank, the issuance of notes normally will debit to cash in bank, so that is an addition, debit to normal balance of cash in bank, but the payments for both principal and interest would be credit. Interest is going to be a debit to interest payable because that is a debit to that, and then payment of interest payable would also involve credit to that if there is an expense. So that's why normal balance of payable is credit account. It will increase when there is interest, and a debit for the interest expense, of course. For TOC and STOT, this would be involving any issuance of the notes and the repayment of principal and interest. So we have to do such things. Analytical procedures also can be done or maintained if, for example, we calculate approximate interest expense on the basis of average interest rates and overall monthly notes payable. So this is just an approximation, and we will be able to check if there are misstatements on the interest expense or the accrual or any omission of notes payable. So that is the good thing of doing ratio analysis. Then what about if we compare individual notes outstanding, meaning unpaid notes, with those of the prior year? We would be able to check if there has been omitted or misstated notes payable. Next, what about if we compare the total balance, the interest expense, and the accrued with prior year balances? So we will be able to check if there has been misstatement in these accounts. Now, what are the two most important balance-related objectives in notes payable? As what we've said, although this is notes payable, and then we look into possible understatement, so we have to check if ever what has been recorded actually existed, right? So, but that concept is normally applicable to sales or revenues or receivables, because we have to check if what has been recorded actually are really existing. Then that's a case of possible overstatement. But because we are now in the part of the notes payable, so that's why we have to extend our analysis by saying that The opposite is true now for the notes payable. We can say that we will still be performing the occurrence or existence, but that's not like one of the two most important balance-related audit objectives. We can still again do existence or occurrence assertion and satisfy that, but what is the more important thing now is completeness. So from source documents to records, what actually has been existing or what has existed actually are included in our record. So this is a case of possible understatement of the notes payable, since we normally understate liabilities so as to improve our financial position. Then also the accuracy or the amounts as reflected on our records. For the types of audit tests, we have to look into this particular summary, although this particular summary is at the end part in the prior videos, but quite unique now. So cash and bank will be affected by repayment, of course, as well as capital acquisition, which is an increase, and then decrease for repayment. For payments of principal, so that would be a minus, but issuance of new notes would be increased. For both payments of principal and issuance of new notes, which are transactions, we would be checking using TOC, test of control, and substantive tests of transactions. For notes payable, then that would increase also by issuance of new notes as said, and then payments of principal will be a minus. So the ending balance will be checked by analytical procedures and tests of details of balances. Then for payments of interest, in which that's a credit to cash and bank, then we also do analytical procedures for the transactions because they are in percentages. So ratios are very important matters in terms of computing interests or percentages, by the way, and interest payable. And if we combine the four, so we would be able to obtain persuasive evidence, which means convincing because they satisfy the quantity in terms of sufficiency or being sufficient, and the quality in terms of being appropriate or appropriateness. So sufficiency plus appropriateness equals persuasive evidence. Then this is an example of a schedule of notes payable and accrued interest. So we have here the payee, meaning our lenders or the creditors, so different banks. And then the date of the note and the date made, by the way, so transaction date and the specific settlement or maturity date, face amount, then the description, especially for collaterals, and then this is the schedule for notes payable, then the balance at the beginning of the period. So this is one way in which we can keep also our working papers as auditors. Then as continued, we have also the notes, additions, meaning pluses, minuses for payments and the balances, then the rate and paid to maturity. Then for the interest, there would be accruals at the beginning and ending. Accruals will be increased by the expense, would be decreased by the payment. Okay, you know these things, guys, under accruals and the accounts. Then third one, objective. Identify the primary concerns in the audit of owner's equity transactions. We're done already with the liabilities. And now we will proceed to owner's equity. For owner's equity, a review of publicly held corporation in which the shares are being issued to the public and those who are interested can buy such, while closely held corporation is being managed by members of family or the family members. And then normally the transactions are limited in terms of issuance of shares to the members or family members. In publicly held, we have many shareholders, so transactions are frequent or many also. But for closely held, simple few transactions, there are few shareholders, normally family members, and the transactions are occasional. For the accounts, well, the owner's equity or the capital accounts would depend upon the form of business organization. Since normally we have more corporations than all other else, except sole proprietorship, which are quite plenty, but then let's focus with corporation. So cash and bank will be affected, of course, with issuance of stocks So that will be an increase, but decreased by the payment or redemption or the buying back of those stocks or shares. Then for share premium, if we issue shares above par, that's an increase. And then this will be affected also when we redeem or buy back the shares. Dividends payable will increase if dividends are declared, but when paid, then a decrease. For retained earnings, all profits will be pluses, losses would be minuses, dividends declared would be minuses also. Internal controls, just like for notes payable, would involve or would check that there's been proper authorization of the transactions. We record properly, we maintain proper documentation, or we prepare proper documents and records. Then we segregate incompatible tasks, duties, and responsibilities, or TDR. Our acronym again is CARE: custody, authorization, recording, and execution. Then in terms of equity accounts, because there are quite plenty of them, there should be an independent registrar, meaning a keeper of the records involving shares and stocks, independent from other people or other personnel or officers in the organization, and a stock transfer agent in cases of buying and selling of shares or issuance of shares. All right, next is objective 4. This is now on the test of controls, TOC, STOT, TDB for capital stock and retained earnings. We have here, for concerns of the auditor, we will look into these balance-related audit objectives or management assertions, completeness also. So it's possible that the equity accounts will be understated, amounts are correct, then they actually have existed based on the records, and in terms of presentation, so how do we present them on the face of financial statements, and disclosure also in the notes. For audit of dividends, we have to make sure that those dividend declarations have been actually recorded. That's occurrence. Completeness is that in relation to clearly that existing dividends are recorded, but for occurrence, we have to check if ever those that actually occurred are recorded. So that's normally the relationship of the two as explained. So they are like two figures in the opposite ends, but supporting with each other. If occurrence or existence, will be checking that those actually that are recorded in the records have actually existed or occurred. Completeness is that those actually that existed are recorded. Then accuracy, again, amounts or values. Okay, so also in their occurrence, you have to make sure that the shareholders who are recipients of the dividends actually existed. For completeness, that the payables are recorded and the amounts are correct. For number 6, accuracy. Next, for audit of retained earnings, the two things that are normally mentioned would be the net earnings or the profits of the corporation which are added. Losses will be deducted, being opposite to earnings, and dividends declared will be deducted. We have already mentioned such. However, we have to take note that retained earnings can also be affected by any corrections or adjustments in terms of prior period earnings. So meaning, let's say there has been overstatement or understatement of the profits and losses recorded before. So that would warrant a prior period adjustment, as well as all other changes in accounting policies which have been ruled out under IAS 8, accounting policies, changes in accounting estimates and errors, that all accounting policies, changes on the methods of accounting for transactions with few exceptions are to be recorded as opening balance adjustment of retained earnings or accumulated profits and losses. And also appropriations of retained earnings, as being discussed a while ago in the previous slides, that these are for specific purposes. So such will be recorded, of course, and will be treated as a minus to retained earnings. So this would increase, by the way, OCI or other comprehensive income, formerly known as reserves, but will be a deduction or will decrease the free or unrestricted portion or unappropriated portion of retained earnings. All right, so this is the end now of the presentation. Thank you very much for listening. Watch out for more videos from this particular series. Thank you and God bless.